Breakout Blockade. Resistance is resistance for a reason. There's a reason that's the title. We're seeing that in a lot of areas of the market. We're seeing resistance levels hold. We're going to talk about this blockade of resistance and what are the roadblocks right now to the breakouts and the resumption of rallies. We're going to talk about that. We've got a lot of stocks in the news. We've got some questions from listeners. But before we get going in any of that, we got a lot going on at Tackle Trading this week. We have a very robust, active pro community, and we try to match their enthusiasm with a lot of content. We have a Tackle 25 mastermind group this Wednesday, something that we've talked about in this podcast quite often in recent weeks. And Coach Gino Poor is going to discuss on YouTube placing orders, talking about how to place those trades effectively and confidently. Matt, a lot going on. What stands out for you this week?
Yeah, Coach Gino on Monday night teaching trading orders on YouTube, our YouTube channel. So definitely check that out. It's at 7 p.m. Eastern Standard Time, going to be about 30 to 45 minutes. I'm just using Thinkorswim and understanding how to place orders, OCO bracket orders, just simple entry versus exit orders, managing stop losses, contingent orders if you're trading options. And so going to do a little bit of trading orders 101 on YouTube on Monday this week. And then also what stands out is the Tackle 25 Mastermind on Wednesday this coming week as well. But always we have a full deck for at all points for our pro members with the Traders Lounge and the coaches shows. So definitely check out Tackle Trading, sign up for a free trial, and come see what all the fun's about.
Matt, this market is starting to remind me of late 2014, 2015 a lot. And if you didn't trade during that time period, I know you did, Matt. I know I did, right? That thing had a lot of chop, just a lot of chop, a lot of chop, a lot of chop. And this is starting to remind me of that market. I mean, we went sideways for one point in that market for 8 months, Matt. Mm-hmm. 8 months, right? And so like in trending markets where people are always like bull market, bear market, the markets can just during certain times of indecision, trade sideways. And it feels like that resistance. And Matt, I heard more than one trader joke this week that it's the you go first market, mm-hmm. right? Where it's like, okay. And what I mean by that is an old, like kind of trading adage, joke where it's like, well, at resistance, you're just waiting for everyone else to be brave. And then you'll pop on for the momentum. And it feels like that's where we're at right now, doesn't it?
Yeah, the you first mentality is a breakout situation where you're at resistance and you're just waiting for that confirmation. And it's just a simple way of describing what you need to see. You need to see the market close above resistance to have that behavioral change, to have that bias change in the market. And my good friend Noah used to just always talk about the you first mentality. Yeah, Noah's a master technician in his own right, one of the finest technicians I've ever known. And he would talk about it in that you first mentality, right? I want to see if we're going to do something stupid together, me and my buddy, I'd like to see my buddy get burned first type thing. Yeah. I would give the analogy of jumping off a cliff, doing a little cliff diving. And if you're 30, 40 feet up in the air and you're staring down at the water, it doesn't seem like a big distance when you're sitting here on your computer thinking about it, but go 30, 40 feet in front of a body of water and stare down and see how long that is. You want to see your buddy jump first to make sure it's safe, to make sure there's not rocks underneath that water, to make sure it's safe for you to go. Same type of concept here on breakout analysis, and it certainly does play with the 610 level on the S&P 500, certainly playing resistance over the last 3 weeks, and really kind of going back to really even in December before we had the Fed kind of go on that hawkish lean in December, the market was kind of kissing up against that 608 level, which was the level before we got to 610. And so this level goes back not just on the daily chart, Mark. You got to think about this chart from a multiple time frame perspective. And I kind of talked about that in detail in the Tackle Trade newsletter this previous weekend for the pros, kind of took a journey through that multiple time frame. But you look on the monthly chart, for example, and you got nothing but a bullish trend with a high base continuation pattern. On the weekly chart, you got a bullish trend with the developing cup and handle formation pattern. On the daily chart, you got I have zero clue because the daily chart is crazy chaotic right now. And so the problem when you're looking at this from a technical lens and a pure technical lens is really the daily chart. And it's really the patterns we've been seeing over the course of the last 2 weeks play out in quite frankly, why we're having this conversation here today. If we were already broken out, we'd have a different conversation here today. But the daily chart is a problem right now. And the pattern on the daily chart is one of rock solid resistance at 610, hesitation at 610. Everybody and their dog tries to get out in front of the weekend to not deal with a gapping situation on a Monday morning. That's the last 2 weeks. That has to be cleaned up, but there is not a flaw on the longer term side of the equation. High base on the monthly chart, cup and handle formation with a hypothetical increase in support right now on the weekly chart, both look prime for breakout analysis. The daily chart has to start participating in that, however.
Yeah, no, and we're seeing this in so many different indices, areas of the market. When I look at ARC, I'm seeing very clear resistance level that is having a hard time breaking out of. When I look at small caps,
I look at ARC and look at a potential opportunity on that breakout, though. I don't see what you see on ARC, just to be clear.
Well, no, but a resistance level in which you have not penetrated.
Resistance, absolutely.
Yes. That's the thing. It's hesitation at resistance, hesitation at resistance, hesitation at resistance, right? Seeing that in small caps right now. And so I go to these different areas in equity markets and I'm seeing clearly defined, right? I mean, we don't have to nitpick on the levels, right? This is one of the things that, as I head, towards the tail end of the week, here on the weekend, where it's like, okay, the levels are very, very clear, right? The levels are clear on the S&P 500, the levels are clear on ARC, the levels are clear on small caps, right? And it's just a matter of penetrating them. Any thoughts on that?
Well, even on IWM, the small caps on Thursday actually tried to close above that test above that 220 level to the 230 level. It was a pretty good technical signal and didn't last but a few minutes, Mark. And so you're looking at a situation.
So a couple people went first.
a couple day traders went first. It was like, ooh, it's not safe up here, guys.
And they jumped in the water and they hit the rocks, and everyone else is like, see, that's why you let them go first.
The day traders jumped, got burned, and the swing traders said, you first, baby. You first next time too. And so I think, as traders go, we are waiting a little bit on a catalyst change. We are waiting on a market theme to a certain extent. We are waiting on a little bit of a breakout, because you're absolutely right, Mark. Every index in some regard is at resistance right now.
Resistance.
And they might not all be doing the exact same thing at resistance. For example, ARC, I just got as a meandering high base, for example, in comparison to what I'm seeing in the S&P 500 here. When I look at ARC's, developing pattern versus what I'm seeing on IWM, I'm seeing a walk on the beach on a quiet Saturday morning, quite frankly. And so you're right that every index is at resistance. 610 on the SPY, RSP, and I'll just kind of give you the numbers here. RSP,
and this stands out to me so much how clean the levels are everywhere.
Yes, the levels are clean, especially on some of these indexes. RSP at 182.5 to 183. The Nasdaq's the one that's a little bit choppy because it does have some overhead, but it's pretty clean at 533 and it's pretty clean at 539. IWM 230 is the number. Diamonds 450 is the number. And so when you're looking at the indexes, Mark, you're absolutely right. All indexes at resistance. All indexes that have multiple weeks to test those resistance levels. All indexes have failed to break out over that time frame, and they're really kind of running a little bit on the same gasoline over the last week and a half, 2 weeks.
And so you titled this podcast Breakout Blockade, and when I came in and we were doing some prep before the podcast, I saw that you had titled it that, the Roadblocks to a Rally, and I was like, because you and I will sometimes be like, what's the title? And I looked at that, I was like, that's perfect. Right, because that describes the combination of the technical backdrop and then the conversation on
I was thinking the
Why
Cuban Missile
haven't,
Blockade when I picked that title, by the
you
way,
know?
and they did let one ship in, so I'm still hopeful for a breakout here.
Yeah. So why haven't we? Because, the resistance is clear, the levels are easy to identify, and yet we can't quite. What have the roadblocks been to a continuation of the trend so far? I thought it was a perfect title. And so, Matt, it spurs the question, right? Because
Yeah.
the technicals are clear, right? If we were just technicians, you and I, it would be an easy conversation. Don't do much, breaks out, get involved. I mean, that's an easy conversation, right? Podcast over.
But we don't have a 60-minute podcast if we did that.
But
I will say, as a technician, as the technician here, okay, because we're both top-down analysts, there's no doubt, but I do put
but
more.
you put more weight on technicals than yes.
And as a technician, if it breaks out at 610 and closes above 610, you should be getting more bullish. Yes.
Yep. It's that. If I get confirmations on small caps, on ARK, on the Dow, on whatever, right?
The Dow's probably the cleanest of the bunch in my estimation, but
it's very straightforward. The technical read, this is why technical analysis is so important. It says, all right, whatever the reason, but as we're here and we haven't broken out those levels, and this is despite what you have told to me and our audience has been a pretty decent earnings season. I believe you gave it an A-. Any changes to that grade?
Yeah, I would definitely come off that. The A- was given after the first week of earnings when we really had the finance earnings, and I would give finance an A. I mean, finance was great. There's been other good companies out there or industries out there as well. It has been a good earnings season. I would give it a B+. But
that's still a great for you're a tough grader.
I never give A's.
You're a tough grader.
I never give A's. Usually I'm a B-, C+ type earnings season environment, especially the last 4, 5, 6 earnings.
I've heard you give D's.
I have, but this one's been good. I mean, blended growth is started around 10%. It's upward north of 16% right now. That's one of the better expansions of blended growth that as we're 3 weeks into earnings season. Blended growth has went up every single week, including this week. EPS beats are at 77%. Revenue beats are around the low 60s, but that's underneath the 5-year average, but the 5-year average is off on that, quite frankly, because of the pandemic. And so the last 2 to 3 years, that's pretty average, quite frankly, for revenue beats. The veracity of the beat is pretty decent right now on the EPS side of the equation as well. And so I wouldn't say it's been a rock star earnings season for every industry and sector out there. For example, energy's been downright just ugly from an earnings perspective. Basic materials hasn't been great, but healthcare, finance, communications really stand out from an earnings perspective. The problem with earnings in the last 2 weeks is you've had the Mag 7 components in the last 2 weeks. And their raw numbers, their top and bottom line numbers have been really, really good. They've all been beats except Microsoft. Microsoft was kind of garbage in my opinion. But the raw numbers, top and bottom line numbers, were not what Mag 7 really kind of runs on. They run on what's happening on the cloud, what's their Azure out of Microsoft, and obviously AWS out of Amazon, and obviously you have your Google Cloud as well. So those 3 big players, Amazon, Google, Microsoft, they all run on AI and cloud-based growth metrics is what they do. And so what we've seen out of these companies in the last few weeks, and it's not just those 3 companies, but when you look at Microsoft, for example, Microsoft did not have a great report, but the biggest flaw in their report was cloud-based growth. It came in underneath the expectation. When you're looking at Google, and the biggest problem with Google's report and the biggest problem with the technical side of the equation right now on Google is, once again, cloud-based growth. When you're looking at Amazon, once again, what was the flaw in there, or in what I would describe as Amazon having a stellar earnings report? Raw numbers were really, really, really good out of Amazon, but what was the flaw? A little bit of lack of growth metrics out of AWS. And so I would say you're, from an earnings perspective, the raw numbers have been the best raw numbers we've had since Q4 of 2021, when we were coming through the early stages of the pandemic recovery. And that's really, really, really good. blended growth has been really, really, really good, a standout. But you do have some concerns on the growth side of the equation from your semiconductors that failed to impress, like AMD this week, or you can go back, all the way back to Taiwan Semiconductor failing to lack a spark in the AI trade. But you just have failed to impress on the growth side of the equation in my estimation over the last week and a half. And you haven't really had one catalyst stock other than Meta. Meta had the best report out of all of them, out of all the Max 7, no doubt about that. But out of Meta, there just hasn't been an impressive guidance report coming out of the Max 7 components. I thought Tesla, for example, was just a ridiculous report, quite frankly. When you're talking about Tesla, and I got a hot take here, I've always believed that Tesla's not necessarily a car company. But if there's one thing that has been proven to me in the last 3 months on Tesla, this isn't a car company any longer. They trade on many, many, many other things. And in their earnings report, they just lack that spark on the growth side of the equation. And so it's been a really good earnings season. But the problem is when you identify growth concerns, and that's all they are, is growth concerns, in an environment where the market has macro concerns, that's going to be enough to put a little bit of a top on the market, quite frankly. And so when you talk about the market and one of the reasons why the market hasn't broken out, I would say one of the reasons is the earnings landscape has not provided that growth metric that would offset some of the other concerns in the marketplace.
All right. So I want to have this little conversation here, but the breakout blockade, what's holding it back? And you're starting off that, one of the maybe building blocks earnings, in a decent earnings, it hasn't been enough to provide the juice is what you're saying. Like it's been decent.
Like the spark. It's like we poured the gasoline on the fire, but we just don't have a spark.
But just not enough juice in earnings. Like okay to hold, but not enough juice to excite.
Can I give you just a stat on that?
Yeah.
Think about it from a guidance perspective, because that's where the concern is, right? When you're talking about growth, when you're talking about the problems of this earnings, it's on the guidance side of the equation. Mark, typically 58% of companies provide some degree of negative guidance. As of right now, we're seeing more than that. We're seeing more than that. Now, I know you don't want me to go too far into my second point, but to give you a little bit of understanding of why guidance is a concern right now is tariffs have also creeped into earnings conference calls. And they're now starting to creep into guidance projections. Right now, Mark, and again, I don't have the numbers off the top of my head, but right now, you got about, I would say out of all the guidance, you've had about 70 companies provide some degree of guidance with tariffs impacting their guidance.
That's a big number.
You've had upwards of 65% of companies issuing negative guidance. And a little bit of concern that the market has right now is for the people that understand that number on guidance, Mark, there's half the other companies that
I did not know it was that high. It's really that high. Holy cow.
And half of the companies that are mentioning tariffs in their conference calls, think about this. I want to get your take on this. Half of the companies that are mentioning tariffs in their conference calls are using it to downgrade guidance. The other half that are mentioning tariffs in their guidance calls are not changing their guidance despite their concern of tariffs, because they're citing, we don't know what the economic landscape is going to be to provide a specific guidance for that environment. And so you have this growth concern coming out of the Max 7, and secondarily, you have guidance concerns based on tariffs that we're now seeing creep into earnings conference calls. FactSet had a wonderful write-up over the weekend, and they do a great job on earnings. I get a lot.
You love FactSet so much.
FactSet, but that tariff conversation is starting to creep in, and I'm sure we'll have more conversations on that. But it's just starting to creep into conference calls, and we're starting to see the early beginnings of it creeping into guidance. We have not seen it creep into EPS projections yet. And that comes after we get done with earnings season. So I got a little concerned that the guidance will lead into EPS reductions coming out of the banks. And I think the market does share that concern right now. Is that a concern if Google would have reported 38% growth in their cloud? Probably not. But when the market's obviously waiting on a spark, these secondary analysis that I would put valuation and guidance in becomes a little bit more important.
Yeah, no, that makes sense. And tariffs, like obviously it impacts different companies and the influence. Let me give you just a stock as an example. I'll say, never mind. I'm going to save that for stocks in the news. I'm going to save that one for stocks in the news. But all right, so
okay, can I give you the specific numbers on tariffs? I just looked.
Yes.
Okay, 146 S&P companies have mentioned tariffs on their conference call. 146 so far. We haven't got through the whole 500 yet. We're only 63% of the way through the 500, and 146 have reported tariffs on their conference calls. Of that, right around 50 have seen some impact in their guidance on tariffs. About 30 companies are reporting they don't even know what to do with their guidance regarding tariffs as of right now.
Yeah. So we have decreased guidance and market uncertainty, two things that markets don't like.
Well, yeah. So take away the tariff conversation and just have an earnings conversation, we're probably have broken out.
So all right. So not enough juice, but some other things. So there are some things, right? Breakout blockade, right? Breakout blockade. We're here at resistance. What's preventing that? And this is a different conversation than what can send the market down 10%, right? Like, what
yeah. No, this is the fill of a continuation breakout. This isn't look out below 30%.
Yeah. So we're not going to be diving into bear porn here. We're going to be talking about why markets are hesitating here. And I would argue on some of the things that, the reasons I think, and you and I have not discussed with each other what our reasons are. For example, I didn't know your earnings. But there are reasons we might share, I'm sure, a few of them. I have 3 on my end.
And specifically on the earnings, the lack of growth spark out of the Mag 7, and then tariffs impacting guidance concerns.
And I think the number one reason right now, and I think number 2 and 3 for me are not too far behind, but Zero Hedge, who is not exactly a liberal rag, I thought they had a sentence in one of their recaps this week that described how traders are reacting to the barrage of headlines coming out of Washington. And this was their exact quote. The volume
it's too much
of headlines, and the word they use is insane. Yeah, the volume of headlines is insane, and the algo's ability to cope with that is getting stretched. I thought that described price action and the general hesitancy in the last couple of weeks pretty well. We all know markets love certainty, right?
They do not like uncertainty.
And they hate uncertainty. And Trump, this or that or whatever, creates, as Zero Hedge puts it, an insane amount of headlines, right? And those headlines,
whether you support or not those headlines, is not the conversation.
We can all agree that the volume,
those are political issues. It's the amount of headlines coming into the financial world that the algorithms are having a hard time pricing in, which they always do in times of uncertainty. That you get chaotic volatility, and I would describe the last 2 weeks as chaotic volatility. Now, some of that is the headlines coming out of the White House, no doubt. Tariffs on week ago Friday, chiefly among them, but you also had DeepSeek in there, and I'm sure we'll talk about that as well. But yeah, continue.
Yeah, no, it's just the pure volume, right? And Trump is not the Trump from 2017. This is not this first year. He is coming at things 100 million miles an hour, right? A lot of people love that, but why he's doing that. But it is creating a volume of headlines in which, in an increasing algorithmic world, let's just say on that little rally mat on the SPY that you show on the chart there, volume wasn't exactly high on Tuesday, Wednesday, Thursday, was it? I think there is some just general
Enough to
hesitancy.
recover the drops, but not enough to provide any degree of spark.
Yeah, I think there is some just general hesitancy. And so when you get up to resistance,
and it's not like there wasn't news coming out on Tuesday, Wednesday, and Thursday either, bro. Like there's still lots of earnings coming out on Tuesday, Wednesday, and Thursday.
Yeah. Yeah. I mean, this, just the pure volume of headlines and the what's coming next, because we do not have a clear tariff plan. We don't know. I mean, things like, even though it wasn't a market story, the Gaza story just came out of left field, right? Like just, oh, wow, didn't see that coming.
Legitimately, not one person was talking about that in the world.
Yeah, like nobody saw that coming. And so in an administration that is moving so rapidly, I think there is some general hesitancy about, okay, what is the tariff plan going to be?
Real, what's not real, right?
Yeah.
Like that has to be because part of the Trump administration's plan is to flood the zone, right? To not only confuse market algorithms, but to confuse media personalities too. And so they have this,
and even partners that you might be dealing with, 100%, right?
Like 100%. They have this philosophy of flood the zone. That's not going to change anytime soon.
And so once again, if the market was down 20%, the net result of these headlines probably is sending the market up. When the market is at the top of the chart, right, it's going to cause some natural hesitancy. It seems like you're in agreement with that.
Yeah, I am. I mean, the market, number one, loves certainty out of everything. The market loves certainty. Why are earnings the most sensitive moment in time for a company? Because it's the number one time we don't know. It's a very uncertain moment as you're going into earnings season. That's why you see radical price action coming out of an earnings report. But in general, so you're just labeling your point one. And again, we're just talking about why the market's not breaking out here so far, obviously leading to alleviation events, catalyst events. But your first point is general.
It's not even, not even. If I had to put a label on it, the pure volume of headlines is creating uncertainty out of Washington.
Creating uncertainty and okay, I certainly do agree with that. The volume of headlines is creating a chaotic environment for traders, and quite frankly, the last 2 weeks, and 2 weeks ago, that had nothing to do with the Trump administration, the White House. That was DeepSeek's news. But yes, I would in general agree with you that the amount of information coming into the market that is not specific is having an impact on the consistency of the financial markets. Now, I will say this: I think the market gets used to that. I don't think this is something that we're going to be dealing with long term. I think this is a short-term situation where everybody in the world was accustomed to something. Now they have to get accustomed to a new thing. And it's not like Trump's going to change. The president is who he is, like him or love him or hate him, that he is who he is. That's not going to change. And so I think the market's going to have to adapt to the level of information that is coming into the market, because I don't think the flood the zone philosophy is going to change. The flood the zone philosophy, and again, whether you like it or not, we're not debating that. This is not a political conversation, but whether you like it or not, that is a strategy that the White House is employing right now. And I don't feel that strategy is going to change anytime soon, because so far it's been very successful for the White House in terms of that flood the zone philosophy and strategic political strategy. So I think it's something the market's going to have to get used to. Now, I also think it's only been 2 weeks. I don't think this is going to be a long-term situation. We've had DeepSeek in the last 2 weeks. We've had earnings in the last 2 weeks. We've had the Fed in the last 2 weeks. There's been a tremendous amount, not just the flood the zone philosophy coming from the White House, although that is having an impact as well. I think the market gets used to it over time, though.
What else you got on your
All right, so you go the flood the zone. We'll call it the flood the zone.
Flood the zone.
And my first one was Mag 7 failing to light a spark on the growth side, increasing valuation concerns, basically.
Yep.
All right. I'm just gonna. I mean, when you think about why the market is broken out, first and foremost, the number one thing I think we can all just say is resistance is tough to break.
Yeah.
It's resistance
There's a reason it's called resistance.
yes, and support, right? There's a reason
Yes.
it's called support. There's a reason it's called resistance. And so it's not easy.
Like, regardless of headlines, Matt, you and I have seen resistance zones where the news flow was lame, it was light, and it still had a hard time breaking those resistance levels.
At 100%. But I think we got to throw in kind of 2 weeks ago, kind of what occurred with DeepSeek, because that obviously that brought concern on the AI trade, that brought concern on the AI growth side of the equation, which that concern has led into efficiency hoopla over companies like Meta and Palantir and so on and so forth. But that concern certainly sent a seismic shift into the semiconductor conversation. And so the next reason I'll give you is just DeepSeek and the impact it had on the semiconductors. The semiconductors are a massive part of the growth story. And I've often been asked in the last 3 months, can tech run without semiconductors?
No.
And the answer to that is no. No, it cannot. It can have a leg, but it can't run. And so when you're looking at that DeepSeek news, the market has recovered from that DeepSeek news. Semiconductors have not recovered from that DeepSeek news. They gapped hard on the Monday that was following it, and they're trying to go through a little bit of recovery stage right now. And so DeepSeek threw another bunch of cold water on leadership, growth leadership out of the market. Mark, if you erase DeepSeek's news from 2 weeks ago, we've already broken out. We're already established a higher level of resistance because the semiconductors were leading that charge. They were leading the charge going into that breakout 2 weeks ago, and the market was primed to break out. It was a little bit overextended. And so when you got that DeepSeek news, it just threw another growth wrench into the conversation. And NVIDIA obviously was one of the ones that was the most impacted, but you saw it across the board with semiconductors. And so I would say you got to include DeepSeek into the conversation and the impact that it had in the semiconductor specifically and downstream of NVIDIA, because when you're talking about a market breaking out, and that has had zero support coming out of the semiconductors, the market ain't going to break out without any help from the semiconductors. Maybe RSP, maybe Dow Jones, maybe IWM, not the SPY, because of the impact that the biggest companies have on the weighted index of the spider. So I'm gonna go in with my second being DeepSeek and the impact that it had on the semiconductor landscape. Now, I think DeepSeek ultimately gets seen as a bullish catalyst over time.
Yeah, for Chinese tech.
Not just Chinese tech.
I mean, give me, Bob, it didn't make my top 5 in the news, but Chinese technology companies have traded well for the last 2 weeks.
Because they've been releasing their latest LLMs every single day.
And I'm starting to in the sewing circles of different analysts being like, well, Chinese tech's valuation is really, really, really low. Right. It's funny how valuation never matters until people are using it to justify
there's not a chance in God's green earth that I'm picking Chinese tech over US tech. I don't care.
I'm just saying it's traded really well. It's traded.
Listen, I get it. I get it. For what was the weakness out of the semiconductors of the US was a win for the Chinese tech space, no doubt about that. They won the battle over the last 2 weeks. They are not winning this war.
Well, that's going to be our top stock in the news here coming up here in a few minutes. But we'll save that winning the war comment here for a second. All right. My next one is inflation, right? Like you were prime on Friday to maybe make a run, despite all of the DeepSeek and despite all of the flood the zone, right? Despite everything, you were coming into these resistance levels on Friday, and you were primed to set up to maybe break out even as early as Friday or early next week. And then on Friday
was bullish, breaking out of a
like you were like
it was good.
Like you were not so far away that we could be having a different conversation.
100%.
But what did we have? What did we have on Friday?
Well, two reports.
Two reports, and unemployment rate came out. The numbers 4.0%, slight miss on the overall numbers. Irrelevant for me. Didn't even register as a market story worth discussing. Average hourly earnings coming in at 0.5%, though. I've seen less numbers cause bigger sell-offs, right? This is a key inflationary reading. And remember, we've had a couple okay reprieve. We don't have to worry about inflationary reports lately, but those were coming off the back of some hotter ones. Inflation is in the conversation, if not maybe in the back of the mind, right? Even if they're not those worries. And then when you got University of Michigan expectations, because if you want to see where the selling really started on Friday, it happened at 10 a.m. Eastern on the intraday chart when University of Michigan released their inflation expectations along with their consumer data. Market trading well. Can you spot the candle where those reports were released? It happened right 30 minutes into the open. That blew up breakup potential, and we're having a different technical conversation. And these inflationary worries, right?
Honestly, without any one of these catalysts that have impacted the market over the last 3 weeks, we're probably talking a breakout at 610.
If we don't have those two inflationary readings on Friday, we might be breaking
at 610, and we're all talking about potential breakout going into next week. Yep.
But inflation is a bugaboo for the market. You cannot have it be a lingering story, let alone causing worries. And those two numbers, the wage growth number, 0.5%, that was the highest reading in a year. The inflationary expectations number, highest number in a year. You can't have inflation be registering, even if they're just one-time shots that are irrelevant later, highest readings in a year, and have the market be like, yeah, let's break out. Let's have fun, right? Let's do it. Let's break out. All of a sudden, pour some cold water. So inflationary readings on Friday blew up the chance at the end of the week, start of the week. Markets will regroup most likely, but certainly for me, one of the reasons that part of the blockade.
Well, right? I think
part of the blockade.
If you're talking about why the market hasn't broken out over the last 2.5, 3 weeks, right? Which is kind of what we're talking about here. You got to go back last 2 Mondays ago and talk about DeepSeek and the impact DeepSeek had. You got to go back a week ago and talk about tariffs and the impact tariffs had. You got to go back last Friday, which was less than 24 hours ago. Well, slightly over 24 hours ago from the time we're recording this, and talk about the impact that wage growth had in the labor market numbers and the impact that the consumer confidence report had on the inflationary side of the equation. Because all three singular data points, all three, happened when the market was at resistance, attempting to break out. And all three data points stopped the market in its tracks, regardless of the price action coming into it. And so obviously 2 weeks ago, you're slightly overextended. That's understood to be a path of least resistance, but you're not overextended last Friday. You're not overextended this previous Friday. You simply had negative news come out as the market was attempting to break out. So I absolutely agree with that on the inflationary concern. And Mark, if you remember back to 22 and 23, when we were having all those very detailed inflationary conversations, one of the most leading indicators of that conversation is wage growth out of the U.S.
Wage growth is a very important number.
Right. Because wage growth goes directly to consumers who directly spend the money, create more velocity of
money. Like it's
2 + 2. Yep.
All right. What else you got? I got one more. Let's see what else you got. Any?
Well, honestly, my last one, my three are DeepSeek on 2 weeks ago, tariffs from a week ago, and the inflationary numbers from this past Friday. All of those in one singular aspect are not enough to stop a market, in my estimation. Just having a conversation on tariffs when it got alleviated 24 hours later, DeepSeek was a shock, but the CapEx spending shock was alleviated 2 days after that. And so, and obviously the wage growth conversation, this isn't the first time we've had inflationary conversations. We've been talking about elevated concern on inflation for the last 3 months. And in fact, in December and in January, that's the reason why the Fed kind of paused on cutting even more. And so when you're looking at those three causations, those are the three in my estimation. the one I brought up at the first, the lack of spark out of Max 7, company with the valuation, those are only concerns because of the other three.
Mhm.
If the other three are not concerning right now, nobody's citing valuation as the concern for the markets hesitating. And yet we are seeing that across Wall Street right now, people citing valuation, and rightly so, Mark. The current PE ratio of the average sector out there is 27 right now. The current forward PE ratio of an average sector right now is 21 right now. The Schiller PE ratio is 38. You could paint those valuation arguments and make a very compelling argument on valuation. And you could have done that every day for the last 2 years as well. So why are people citing valuation? Because there's other concerns.
Because it's always one valuation on the low side, on the top side. It's always kind of, listen, and I have one, it's not part of the current blockade, but they're getting ready to join the blockade.
Mhm.
This is a Fed that's turning hawkish.
Yeah, that's baked into the inflationary one for me, but
this is a Fed that's turning hawkish. You have seen speakers for weeks and weeks and weeks now up their hawkish rhetoric, Bowman, Logan, etc. Yes, Waller had, this is where bulls, like Waller had one dovish speech thrown in there, and that's the only one that the bulls wanted to talk about. But then you had people like Austin Goolsbee, who we make fun of in this podcast for being the biggest dove in the Fed. Like, that guy hasn't seen a reason not to cut. He is the Tom Lee of the Fed, right? Where, Tom Lee comes out and says, yeah, why shouldn't you worry about everything, right? Because the market is going to go up. That's Austin Goolsbee for the Fed. He for 2 years on the Fed, cut, supportive, easing, super dumb, like ridiculous stuff. I gave 3 speeches this week, man. Not 1, not 2, not 3. He was hawkish in all 3. He was hawkish in all 3. Talked about tariffs, talked about policy, talked about, listen, we might have inflation under control at one point in one of his speeches, but even if we get to 2%, that's not reason to cut. That was Austin Goolsbee this week, right? This Fed's turning hawkish. This Fed's turning hawkish. We'll see where it goes from here, but hasn't really impacted the price at all to this point. But if you get a Fed that turns hawkish and you price out any cuts coming in 2025, that's gonna matter.
I agree with you that the language coming out of the Fed has been slightly hawkish recently. Yes, I would agree with that, and rightly so. Rightly so. We've had inflationary concerns for 2-3 months. That's not getting alleviated on the inflationary concerns. The latest data was just the wage growth coming out on Friday at 0.5%. Consumers are getting concerned again on the inflationary side of the equation. And right or wrong, egg prices are, part of that concern right now. And the right or wrong part is, you can't blame the Fed or the presidency on the current egg price situation. No. But it's still going to have an impact on how consumers behave within the economy, right? And so you look at the situation right now, and if I'm a Fed member, I'm getting very hawkish in my language, specifically in the language, as a way just to kind of throw some darts at the powers that be, to be like, listen, if you want a Fed that is a supportive of your fiscal policy, we need to get our control over the monetary side of the equation. And so there's a lot of moving pieces to this conversation on the inflationary side of the equation. This is the second attempt for double dip inflation. If you'll remember, there was about 2 years ago now?
No, it was 1 year.
It feels like 2 years, but
it was 1 year ago.
We had that 2 months consecutively.
It was 1 year ago.
Inflation, and the Fed took a hawkish stance for about a month, right? But then they got a couple data points that changed everything. Now, obviously, the Fed's getting a little bit more concerned on the inflationary side because the tariff conversation is, and I get so sick of debating this. The tariff conversation is absolutely an inflationary-based conversation. There's no doubt about that. You have to look at it through the lens of inflation. Whoever's going to pay it, you guys can debate that all you want, but it is, somebody pays it, and it goes across the economic system. And so the Fed is looking at an environment where they got wage growth going up, which is a positive for people having more money to spend, but more money to spend equals what? Higher levels of inflation. And so the Fed is absolutely getting a more hawkish at this point than they have been in a while, I would say.
In a while.
I wouldn't say they were this hawkish in their language at any point during the pause. And the pause mark has been 18 months so far. Like,
yeah.
This feels like the most hawkish the language is being. My question
I don't think there's any debate.
Is it just language, though, at this point? Is the Fed going to act on this, or are they just going to sit on their hands, in your estimation?
I don't think they're going to raise rates. They won't do that. They just won't do anything for a long time.
So they'll just maintain the pause, basically.
This is going to be an extended, my base case right now is a very long extended pause.
Well, if that's the case, cutting 2 consecutive times last year will be a mistake.
Yeah, this is going to be
you cut interest rates right before double dip inflation hit the market. Like, I'm sorry, 2 years from now, there's only one person to blame on that, and that's Powell.
Well, yeah, trying to juice the market in an election year.
We know. We know exactly what you were doing, pal. And
all right, so
we know exactly what you were doing, Yalen and pal. You were just there because
we got some weights. We got some weights on the market. More weights added every week, it seems. We'll see how it navigates resistance. One area that's shifting to commodities, and you can apply the same analysis to Bitcoin. I don't have anything to add on Bitcoin this week, but in gold, in silver. And we're starting to see that in copper. We got some interesting dynamics, Matt. We got some just pure squeeze aspects working through the system. It's been really, really strong momentum. You and I were talking about some things going on in the London exchange. All that gold's getting sent to America, right? As a potential, and long story short, there's like arbitrage systems that when the price of one major market is out of balance, they'll shift markets back, gold back and forth. Well, gold potentially can get impacted by tariffs like lots of other things. Now, we don't know that it will for sure. This has to go with the general uncertainty, as we don't know a lot of the things, but there's been some just really robust price action, not just in the gold futures, not just in gold miners, but in the transferring of gold from London to America. It's causing some speculation that the gold might be
25% tariffs on gold imports.
Nobody does. That's why it's happening.
It's coming home. Yeah, London is a hotbed to store gold from around the world. The London banks are, and this is very interesting. I want to know more about this story.
Oh yeah, absolutely.
Right now, you're basically seeing hoarding happening from in gold from the London Stock Exchange,
and Matt is not using hyperbole, using literal hoarding.
Like you
literal
have
hoarding
in London, you're bringing it back to the U.S. is what's happening, and I've seen reports anywhere from like $82 billion worth of gold, upwards of $132 billion worth of gold so far, and there are reports that London is running out of gold, and that is creating a little bit of squeeze on physical demand. And so you're seeing demand increase in an environment where they don't have supply, and you're going to have short squeezes.
And as London runs out of gold, how they're settling these things right now are IOUs. Like basically,
it's taking 8 weeks to deliver physical metals right now.
We'll take it. Remember Jim Carrey in Dumb and Dumber, where he had spent all of the money. And the guy comes for the suitcase full of money, but all it has is IOUs. Jim Carrey
it's as good as gold.
It's good. Jim Carrey's like, it's just as good as money. It's an IOU. That is how
the Bank of London
tens of millions of dollars are being settled.
That's so ridiculous.
We'll get you down the road.
Yeah.
I can't get you those metals today, but here's an IOU. I'll get you 6, 8, 12 weeks.
Well, but that's part of the concern right now is there is thought that there's going to be 25% tariffs on gold imports coming out of London. Whether that happens or not, we don't know. But because there is concern and chatter on that, what does everybody that owns gold in London do? They got to pull it back before they get taxed by 25% import. And so it's creating companies, institutions that are forced to make decisions based on the hypothetical nature of something.
Yeah,
chaotic environment, honestly.
Chaotic. And let me give you an example of that chaos, how it is starting at the end of the week to bleed into the paper market. Give me GLD, right? GLD is one of the most popular ETFs in the world, and we'll look at SLV here in a second. Tracks the price of gold. It's not backed with physical gold, trades on the futures. But, Matt, you can go to the trade tab on TOS for those people on YouTube watching this. There were points where this became hard to borrow on Friday. The rate of SLV
same with SLV, by the way.
Same with SLV, hard to borrow. I have never seen that in a million years. Saw those hard to borrow.
Not like that.
The rate, because these things are as liquid as they get. Mm-hmm. Like these things are like insanely liquid ETFs. Hard to borrow.
For retail, that it's never an issue on SLV and GLD, and it was interesting.
And then the rate to short to borrow against on SLV was 16%
right now.
That is like, it's normally 2. That is an all-time high.
That's basically the bank saying, do not borrow this money.
No, we are not supplying you shares to short.
Yeah,
we're not doing it because there's some interesting things which could create some interesting price action on these instruments, right? Short squeeze potential. All I know is that it's crazy out there right now.
Yeah, but don't you like, if there is a short squeeze happening out there, because there are some very interesting dynamics happening in SLV and GLD, isn't that bullish?
What? Well, I mean, if you short squeeze 101, you make the borrowing cost impossible to short. The borrowing cost on existing products, people shorts have to buy back, close their shorts, and buy shares, which increases demand. This is how short squeezes occur, right? This is how, I mean, just the mechanics of it. We all got,
make it so expensive to do it that you have to buy it back.
You have to buy it back, right? They eliminate that
on the increasing margins when they want to see price come down. They might be stuck between a rock and a hard place on this one, and gold might be the hard place.
Yeah, and so just some really interesting dynamics. You know, like I'm involved in all of these instruments, obviously gold, but you know, watch how that story plays out. Obviously, we'll give updates in all of our programming this coming week as it plays out in real time. But fascinating, just it's Trump policies once again, though. Like, are there tariffs on gold? Are there not? Creating market dynamic weirdness until we know. And as we gather more information, as those policies get set, markets get back to normal business. That's how this plays out. It's just going to be some interesting moments.
Yeah, and again, like, we're still only 2.5, 3 weeks into the Trump administration.
No, we're not. We're like 8 years.
It feels that way right now, but the market has to give a little bit of a grace period to understand what's going on is my general point. I think
algos don't give grace periods. They're like, let's do it now.
Algos get confused, but the people that program the algos figure it out over time. My point is,
most certainly do.
Much like in 17, the market got very used to Trump, just started pricing things in. I think the market will get used to the strategic advantage that Trump has right now of flooding the zone.
All right, let's talk about the top 5 stocks. Palantir, going to do top 5 stocks. Palantir for me, not because of the price action that has its own interesting. It was the comments made out of management that I thought were amazing. Palantir had their earnings. They set the stage. Right. It was going to be really interesting to see how AI related names responded after the DeepSeek news the previous week. Right. Palantir had earnings on Monday, rewarded investors, big gap up, follow through. But it was the commentary out of the management that was really interesting and thought provoking and played to the larger conversation, not just the trade, but the next decade plus, where they talked, listen, we're at war with China. We're going to need to spend as companies a lot of money to win that war, referring to the technology war with China that is there. The fact that they would use that phrasing to describe it, I thought was appropriate. And describe from a big picture narrative,
I've been
AI
using
spending ain't
that
going
word
away.
for
I
a
know you
year and
have.
a half.
I know you loved it when one of your favorite companies used the same language. But it's like,
No, it's important to have appropriate language to describe what is happening right now between the U.S. and China, and Palantir understands this more than probably any other company in the United States right now because of their government contracts with the United States. We are in a Cold War economically with China. There is not a debate on that. It's been going on for years. And now the US is getting a little bit more aggressive in the combating of that. But this has been going on for a while. The AI arms race just heated it up. But I listen, I'll celebrate any company that comes out and calls a spade on what's happening on the AI arms race between the US and China. It's the most obvious thing that's happening economically right now.
yeah, no, and it's just a reminder, like hold your horses on what and we talked about this last week when the ASML CEO talked about, hey, listen, this is going to breed more chips now. And I liked your comments there, maybe not for his company and all that because he's high end,
I was gonna
but
say,
but the Palantir, management when they were talking about this, it's like it makes it so clear. It's like, no, improvements out of China are only going to get us to do more. It was very Sputnik like, that, what we
like
discussed
not
last week.
every economic Cold War has to rinse and repeat Russia versus the US from 49 until 1989. Like that's not every Cold War. This is an AI arms race. It's an economic war. And yeah, maybe call it a competition like Biden used to want to call it, right? To be friendly, whatever. Okay. We are as competitive as historically it gets on this conversation between the economic competition. I hate that word already. I'm not going to say it. The Cold War that is happening between the U.S. and China, and Palantir knows it. It's one of the reasons why I love the company.
Yeah. Another company that I love, Uber. I was going
By
to
the
say
way,
for them.
Palantir 40% beat on EPS. Every one of their growth metrics was impressive. The numbers were more impressive than the commentary coming out of their earnings report, in my estimation. Number one growth stock in the market, in my estimation, is Palantir as of right now. It's high valuation though, like valuation nonsensical right now.
Yeah, no. So Uber. Give me Uber. I was gonna save them for 5, but screw that. I'm in a good mood. I want to save. This one's gonna get me to lob some naked puts. This company has a huge moat. Self-driving, blah, 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 robotaxis, blah, 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 blah. This company's starting to make some cheddar. Remember way back in like 18 months ago when people were worried about Uber ever not making money again?
Mm-hmm.
Literally, that was a market conversation. Is Uber ever going to turn a profit? Is Uber ever going to turn a profit? Is Uber ever going to turn a profit? Right? Matt, talk to me about those numbers because that tells the story.
The raw numbers here on Uber are absolutely standout, no doubt. And the price response on their earnings here, you look at it right here, kind of the gap down in price on Monday.
P21 actual.
I can't believe this sucker gapped down on earnings. Like and the fire
Market
is 100% legit. The breakout of 70 is legit. Get it on secondary pattern watch, no doubt about that. The numbers are outlandishly good. The expectation was 50 cents. They came in at $3.21. That is 2 middle fingers up into everybody who questioned their profitability 18 months ago. That is a rock star EPS beat. Revenue is up 20% year over year as well. However, bookings, and this is why it did gap down on earnings, because the headline number of bookings, that's their guidance. It was decreased by 1%, but it was a standout report in my estimation. I felt like the market was emphasizing the bookings number a little bit too much. This was a standout report. The breakout of 70 was legit.
Yeah, this I'm gonna lob a boomerang.
Let it calm down though, obviously.
I'm lobbing naked put boomerang for ownership. One of the questions we have in coaching this quarter, how to handle in those naked puts on that. We'll talk about that in a second. Love the report. Love the company. It
was good report. Good company. Yeah, Palantir. I had Palantir and Uber both on my bull quick hits for the week. I had Palantir 1, Uber 2.
Now, Google / Amazon, I have as the same stock story, right? Like, mega cap tech has not been trading well recently. Earnings, and you talked about this at the start of the podcast, so don't want to belabor it, but raw numbers, fine, right? And commentary on AI, fine, right? Like, as far as that CapEx we're spending for the future. I think the Amazon CEO had like some like insanely quotable, stick them up on the board things about AI is the future. It's awesome and all that. But the guidance, and you talked about that, and mega cap not trading very well right now.
I thought Amazon had a better report than Google in totality. Amazon is I want to believe they had a record for from a revenue perspective. I'm not just talking Amazon, I'm talking like anybody. Just had an absolutely just standout raw numbers. The top and bottom line numbers on Amazon was absolutely fantastic as well. Google not as good on the top and the bottom line as Amazon was, but both companies saw the same type of impact on their earnings report. Sell first, ask questions later, because both had the exact same concern on cloud. And that's really what was the driving force here was cloud growth came in under expectations. And I cannot tell you how many times I have reported on cloud growth over the last 10 years, Mark, because cloud growth isn't an AI story. It is now, but it's been cloud growth's been a story ever since Microsoft created Azure all the way back in 2010. And from 2010 on, that became the growth segment out of Microsoft. Well, you saw it with Microsoft last week. You're seeing it with Google and Amazon this week. When you're looking at Azure, they reported, I believe, 19% year-over-year growth. It obviously was a miss. Google came in at 30% year-over-year growth. That expectation was, I believe, 32%. So we're not talking about significant misses here, but even a slight miss in an environment where there's 14 other things the market is concerned about right now, as we had in the first part of the podcast conversation. That's enough to kind of take on the emphasis of it's on its own. But again, if you're looking at Amazon's raw numbers were fantastic. Google was not bad on the raw numbers side of the equation, but they had a little bit of a negative reaction to the Gemini announcement. Gemini 2.0 as well was released as well. So news is happening fast and furious in the tech space, no doubt. But the cloud concern took on the identity of the earnings release itself. Nobody cared about the raw numbers, but as the market environment smooths out and the market stops being as concerned as it currently is with all the things that are happening in the market, my guess is Google and Amazon bottom out and people aren't as concerned on the growth side.
Next two, lumping these together, ARM and AMD both had earnings this week. Both were very interested. You will never see ARM have an earnings report reaction like that again, where you don't know that they had earnings. That was just interesting in and of itself. On that. AMD hasn't been trading well. AMD did not impact semiconductors as a whole. ARM did not. Semiconductors seem to be stabilizing as a collective group, not influenced by anyone. Was not terribly impressed with AMD's earnings report. Did not like how they stopped reporting AI products. Kind of gave me that kind of look that listen, you can AI can be alive and well. Not everyone's going to win equally. What was your take on ARM and AMD?
You're a growth company with high valuation and you came in line on EPS. That's all you need to know on AMD. Like that's it. I've seen them come in line for the last few quarters. Honestly, they came in line here on this quarter, Mark. Look what happened. Look at the trend that happened after they came in line. And so they came in line this time. You saw the gap down. Market got it right. You got to impress. And there's the 200 weekly is kind of where the price is, but that's a tough look for AMD. ARM is a little bit of a different story here, a little bit more wider range neutrality, I would say. Slight bullish uptrend in the ultimate short term. I thought ARM had a better report in totality than AMD did. ARM is quickly becoming one of those more talked about semiconductors over AMD. Neither one of them will ever touch NVIDIA and what NVIDIA has done and the leadership it has. But I thought ARM had a better report than AMD did.
Final one is Mag 8 component Eli Lilly. Remember that like 7 month stretch where it was the Mag 8, right? It's like we gotta put Eli Lilly. Well, Eli Lilly doing a little to remind that some volatility, and then came down, has traded sideways several months, breaking out of that on earnings. What was your take on Eli Lilly? It's easy to forget, right? Like Eli Lilly was one of the biggest market stories in 2023 in the first half of 2024. Did it have the kind of earnings report that can spark that excitement again?
Well, their drugs, the Zepbound and Mounjaro drugs is what Eli Lilly trades on, and those sales were through the roof through the quarter. So, yeah, there's been concern on cheap knockoffs on those two drugs and how it's going to impact the overall totality of sales. And at least for this specific quarter, it did not impact that at all. Eli Lilly actually had some pretty decent raw beats, 532 against 503, for example. And so right around a 7% beat against EPS. Revenue was increased year over year as well. They didn't officially raise guidance, but what they did do is they basically raised the range of the top end of their guidance. So slight improvement on guidance, I would say, out of Eli Lilly. And then they offered increase in dividend as well. Isn't enough to create the growth environment of Zepbound and Mounjaro from all the way back? No, but is it good enough to send it back up into resistance? Most likely. I got Eli Lilly on secondary pattern watch.
All right, let's get to Coach's Corner, where we take questions from listeners. I got 2 questions from listener and one I'm pulling from the Traders Lounge. In the Traders Lounge, part of our pro product, we answer questions at the end of every Traders Lounge. A variety, basically anything goes. Sometimes those Q&A sections are 10 minutes, sometimes they're 45, right? Because we'll stay there until
the questions stop.
They go until the questions stop. My favorite question of the week, Matt, when I was listening, was when somebody asked you, how long is it going to take, Matt, until I become as good a technician as you are? Right. I loved your response. You gave a good 10-15 minute response. It was fantastic. It was a great educational segment. Give me a 60-90 second abbreviated version of that.
First and foremost, I think you can master the concepts of the basic structure of technical analysis within weeks to months, the basic structure. But my answer was not that. Like I said, if you sat your butt in a chair for a year to 2 years, you could master technical analysis. There's no doubt about that. But my answer was a little bit more mindset driven, that it's not just a matter of the amount of time it takes to master the concepts of technical analysis, because technical analysis, whether you like it or not, is based on human behaviors, and that changes, which means you need to make a decision in your life whether or not you want to master this concept, not how much time it takes you to master a concept in general, but do you want to master this concept for the rest of your life? And then I talked about basically how, Socrates way back in the day was basically made a statement where he said, I am the smartest man in the world. And he was later put to death by the Greeks for making that statement. The Greek politicians, how can you claim you're the smartest man in the world? How can you dare claim you're the smartest man in the world? And he said, because I admit I know nothing. You have to make a decision whether or not you want to have this skill set and then dedicate your time to that skill set, to the knowledge of that skill set. But at the end of the day, you have to admit to yourself that you are a student for life. And that's what I think Socrates' greatest message was out of that story, is I am a student for life. Knowledge, there is no end conclusion to the journey to obtain truth and knowledge. I was talking to my son the other day and about not this concept, but about another concept, and I was saying the same thing. That there is no conclusion to that journey towards truth. That there is no journey, there is no conclusion to the journey of do I have enough knowledge? Because regardless of how much knowledge I accumulate in my life, at no point do I use 100% of what is up here. And so you got to make a decision on those two facets. Number one, do I want to master this skill set? And number two, do I want to be a student for life? Most people think they stop growing it when they get done with schooling. That's not the case. That's when it starts.
All right. I love that conversation. It was so fantastic. That was a great recap. Next question we have, is there any difference in strike prices if you are selling a put as part of a boomerang, i.e. I want to own the stock, or if I'm just selling a put as a trade? I'll give the base answer here. Listen, as a general rule, and there's, depending on different technical charts, but as a general rule on a boomerang, you are going to want, and if you want to own, forget the term boomerang if you're unfamiliar with that. If you basically want to own, you're going to want to identify support levels. You're going to want to be more aggressive with those puts as a general rule, selling them above the support level, right? Because you want to give support a chance to work and you don't mind ownership. And so you can get put in a lot of great put. I didn't intend the pun, but pun intended. You can, you can be put in a lot of great situations where you're put the stock above support, but support still holds, which is the perfect, kind of sweet spot. Now, if I don't want those shares, and for whatever reason, I'm just trying to collect some credit, you're going to want to give yourself some more breathing room, right? You're going to want to get that underneath support where you have room to navigate. Give me the, if we're for the YouTube audience, give me the Google chart. For example, if I said, I'm going to give the 50-day moving average a chance, but I don't want to own the shares of Google, right? Well, if I put it above the 50, if I was aggressive, all of a sudden on Friday, I'm like, I'm going to have to close this out. I don't have any room to breathe, right? If I was just trying to collect the credit, I got to get, and it's going to mean less credit, but it's going to give you far more management flexibility. Selling puts when you do not want to own the shares can be tricky business, should only be done by experience, and you're going to want some breathing room when you do that.
Yeah, and the only thing I'll add to that, fantastic answer. Of course there are. Number one, if you want to own it, sell above support. If you never want to own it, you want support to work for you, sell it underneath support. Number two, Mark, if you don't want to own it, then I also wouldn't sell a naked put in an overextended condition.
Yeah, never do that.
So, but if I did want to own it, I would.
I wouldn't care.
Right? Because you,
for example, GDX
retracement level that you were comfortable owning it at, right? Yeah. So if I was comfortable owning it at this old support, old resistance, hypothetically new support, that would be a retracement zone at 39. And if you wanted to own it, you could sell a naked put on GDX right now with the intention of owning it if it ever comes down in a retracement to 39. But if you did not want to own GDX, there is no chance in the world you should do that, because that's a probable outcome in an overextended condition. And so,
great example.
Yeah, it's a good one, but that's a great question as well.
Final question is, listener asks, I've made some mistakes. He doesn't refer to what mistakes he made, but I've made some mistakes in the first 30 minutes of trading, specifically at the opening bell. Would you advise not trading the opening 30 minutes? Now, I don't know what mistakes they made, right?
I'm assuming entry into option trades.
I'm assuming it's entry into option trade, because if you put a market order or something particular,
it's not.
You can get some really bad outcomes.
You want to talk about the inefficiency of the market. The bell is when the opening bell is the most inefficient moment that option will have throughout the day. Would you agree with that?
Oh my, I have seen individuals put in market orders that basically got like the full spread.
That's why you should attend Coach Gino on Monday, who's going
to... I didn't even tie that in. That is such a great thing. Like, I didn't even intend that. I honestly did not intend that. That is such a great lead in for Gino's show on Monday. Right. So, but yeah, like,
by the way, for the pro members, we did that for 2 straight weeks in the Tackle Trading Coaches Show. And on Tuesday this week during the Coaches Show, I'm going to be doing a live tutorial on the active trader in Thinkorswim. So you see what we do for our pros.
Yeah. So in the opening, I do things throughout the day, right? Now, will I do certain things? For example, if I have something like L, who I had to make a trade management on a put spread I had, right? It has really illiquid bid-ask spreads. I'm not doing that in the first 30 minutes.
Yeah.
Right. I'm going to wait until market settles in to do something. Things on the SPY, right? Or maybe it used to be GLD or SLV. We'll see how the Monday goes on those. But liquid, then I'm far more willing, right? Because I'm going to have right from the get-go,
Yeah.
not very much difference.
Like,
in
for
the
example,
spread.
those penny spreads that you see on like Apple and the SPY and the GLDs and the very liquid, those are perfectly fine at the open. But there is some illiquidity on the option side of the equation, especially at the very open. So that's a
Yeah, and even things that will get super tight, like FCX is a good example.
Yeah.
Like FCX on Friday morning, I was looking because I wanted to do something on FCX. FCX has a really liquid option chain.
very
Right, very liquid option.
do
But
whatever you
the
want.
bid-ask spreads for the first 10, 15 minutes were crazy
Yeah.
at the open, right? And so wait for that to settle in.
Awesome.
You know, all that. All right,
Awesome.
Matt, great podcast. Send us out, bro.
Yeah, if you love the podcast, ladies and gentlemen, you will absolutely love everything we do in our pro membership, because we do a tremendous amount, from the 4 Traders Lounge we do every single week, to the 2 coaches shows we do every single week, to the newsletter, to the reports we put out for the weekend, to just hanging out with our community in general. If you're looking for an amazing trading community to both educate as well as get the application side of the equation, come test out Tackle Trading, sign up for a free trial membership, and you can test out all those goodies in our pro membership, no doubt about that. You can get a 15-day free trial by going to tackletrading.com, hit the storefront, or hit the link in the description below. And once again, don't sleep on Coach Gino on YouTube on Monday, 7 p.m. Eastern Standard Time, talking about trading orders. And for our pros this week, we got the Tackle 25 Mastermind group on Wednesday, and got the coaches show that I'm going to be doing a active trader within Thinkorswim tutorial. So if you've ever wanted to learn how to use the active trader, I'm going to be doing a tutorial in our coaches show this Tuesday at 8:30 p.m. Eastern Standard Time. With that said, I hope everybody has a blessed week, has an amazing week. And if you need anything from us at Tackle Trading, hit us up at team@tackletrading.com. You can hit us up in our Tackle Trading Discord or any social media channel as well. And last thought, if you want to help us out on the podcast, give us a like and share on any platform you are currently liking or listening to the podcast on.
Have a great week, everyone.